$114.45. That is where Brent crude is trading right now, up 23% in a single session. Let me say that again so it lands properly. 23% in one day. The last time the oil market moved like this, Russia had just invaded Ukraine. Today, the reason is different, and in many ways, it is more serious. Tonight, we are talking about oil. We are talking about the Strait of Hormuz, and we are talking about what happens to global energy markets when the world's most critical waterway goes dark. This is not a drill, and this is not speculation. This is happening right now, and by the end of this episode, you will understand exactly what it means, exactly which price levels matter, and exactly what to watch in the next 24 hours.
Good evening. I'm James Harlow. Welcome again to The Right Chapter. Let's start at the beginning, because to understand why oil just did something it has not done since the early days of the Russia-Ukraine war, you need to understand the geography, the players, and the sequence of events that brought us to this moment, the Strait of Hormuz. If you have been watching this channel for any length of time, you have heard us mention this waterway before, because in the world of oil markets, it is the single most important piece of geography on the planet. Picture a narrow corridor of oceans sitting between the southern coast of Iran to the north and the coastlines of the United Arab Emirates and Oman to the south. At its narrowest point, this strait is roughly 21 miles wide. That is not very wide. And yet, through those 21 miles, every single day, approximately 21 million barrels of crude oil pass. That is 1/5, 20%, of all the oil consumed by the entire planet. Saudi Arabia's exports go through here. Iraq's exports go through here. The UAE, Kuwait, Qatar, all of it funnels through that narrow corridor. When something threatens to close it, the oil market does not wait to find out if the threat is real. It prices in the worst case immediately. Now, what actually happened, and why is it more serious today than the many previous times Iran has threatened this waterway? To answer that, we need to go back to February 28th of this year, when the United States and Israel conducted joint military strikes on Iranian territory. Those strikes targeted nuclear facilities and military installations. Iran's response was swift, and it was multidimensional. On the ground, Iranian forces and Iranian-backed proxies began striking American military installations across the region. In the air, drone and missile attacks escalated across the Gulf. And at sea, the most consequential move of all, Iran began what analysts are now describing as an effective closure of the Strait of Hormuz. Pause. Not a formal blockade in the legal sense, but a campaign of harassment, threats, and actual attacks on oil tankers attempting to transit the waterway that has brought commercial traffic to what one source described as a near standstill. Iraq, which relies almost entirely on the strait to export its oil, has already shut down 1.5 million barrels per day of production, not by choice, but because there is nowhere to send it. Storage is full. Tankers are not moving. Kuwait has begun doing the same thing. The UAE, one of OPEC's most reliable producers, is facing severe supply constraints. We are not talking about a threat to supply anymore. We are talking about actual, measurable, real-time supply destruction. And the market is pricing that in as fast as it can. The geopolitical backdrop here has been building for years, but the pace of escalation in the last 10 days has shocked even the most seasoned analysts. The US-Israel-Iran triangle has been the defining tension arc of this decade, and now it has moved from proxy conflicts and economic sanctions into direct military engagement. President Trump has demanded unconditional surrender from Iran. Iran has responded by striking US facilities in the UAE. Israel has now conducted its first ever airstrikes directly targeting Iranian oil infrastructure. What we are witnessing is not a flare-up. It is a fundamental restructuring of the Middle East security architecture, and oil is the asset that sits at the center of it all. Now let's talk about the mechanism, because this is where The Right Chapter earns its name. Understanding how geopolitical events actually translate into oil price movements is what separates an informed investor from someone who is just watching a number on a screen and feeling anxious. Oil pricing works through something called a risk premium. Think of it this way. Imagine you run an insurance company and you're pricing a policy for a house in a neighborhood that is normally very safe. The premium is low because the risk is low. Now imagine that same neighborhood has suddenly developed a series of fires. The premium goes up, not because any given house has necessarily burned, but because the probability of a claim has increased. Oil markets work exactly the same way. At any given moment, the price of oil contains a base component, reflecting actual supply and demand, and a risk premium component, reflecting the market's assessment of what might go wrong. Under normal circumstances, that risk premium might be $2 or $3 per barrel. In a situation like today, where the world's most critical oil transit route is effectively closed and major producers are cutting output, that risk premium can jump $20, $30, even $40 per barrel almost overnight. But here is what makes today's situation particularly significant, and why I want you to understand it as more than just a short-term spike. We have crossed from risk premium territory into something different. We have crossed into actual supply disruption territory. The distinction matters enormously. A risk premium can deflate quickly if the situation resolves, if there is a ceasefire, if diplomatic talks produce a breakthrough, if the strait reopens. But when actual barrels stop flowing, when Iraq genuinely cannot export 1.5 million barrels per day, when Kuwait genuinely has no outlet for its production, when tanker captains are actively refusing to transit the strait because the insurance costs are prohibitive, you have a structural supply problem that does not disappear with a press release. JP Morgan's head of global commodities research put it in terms that every investor should hear. She said, and I'm paraphrasing here, that the market has shifted from pricing pure geopolitical risk to grappling with tangible operational disruption. Production cuts could approach 6 million barrels per day by the end of next week if the strait remains closed. 6 million barrels per day. To put that in context, that is roughly 6% of global daily consumption disappearing from the market simultaneously. The last time the world lost that much supply that quickly was during the Arab oil embargo of 1973. We all know what happened to oil prices then.
There is another layer to this story that is absolutely critical and that mainstream coverage is not spending enough time on. US shale, the great American energy story of the last 15 years, the production base that gave the US energy independence and allowed it to sanction Iran without crippling its own economy, cannot fill this gap. Not quickly, not at scale, and not logistically. American shale production is geographically concentrated in Texas and North Dakota. It takes months to ramp up new wells. It takes pipeline capacity that does not currently exist to redirect those barrels to replace Gulf exports on short notice. The energy analysts who follow this most closely are essentially saying the same thing. There is no quick fix on the supply side. The cavalry is not coming in the next 30 days.
Goldman Sachs, which has been one of the more measured voices on oil prices, said last week that prices are likely to exceed $100 per barrel if no resolution emerges. They said that before today's move. Surprised, we are now at $114. Qatar's energy minister went further, telling the Financial Times that prices could reach $150 per barrel in coming weeks if tankers remain unable to transit the strait. $150. The last time we were anywhere near that number was in the summer of 2008, during a period of extraordinary global demand growth. The context today is very different, but the price destination may not be. Now let's talk about what this means for you, not as a trader watching a screen, but as someone who owns assets and wants to understand what is actually happening. Every dollar increase in the oil price is in effect a tax on the global economy. It costs more to manufacture things. It costs more to ship things. It costs more to fly. It costs more to heat your home. That is inflationary pressure, and it arrives at a time when central banks in the US and Europe were cautiously beginning to signal that inflation was coming under control. If oil stays elevated at these levels for weeks or months, the inflation calculation changes completely, which means the interest rate calculation changes, which means the cost of mortgages, car loans, and business credit changes. This is not just an oil story. It is a story about the financial conditions that every American, every retiree, every investor is going to be living in for the rest of this year. Let's get precise with numbers, because that is what this channel does. As of this recording, Brent crude is trading at $114.45 per barrel. The session high today was $119.50, a level we have not seen since 2022.
The session low was $99, which tells you that even on the bad end of today's trading range, we were above the psychologically critical $100 threshold.
The first level I want you to watch is $100 even. In oil markets, round numbers are not just psychological, they're structural. When Brent trades above $100, it triggers a different set of behaviors. Governments begin to talk seriously about strategic reserve releases. Central banks begin to revise their inflation forecasts. Consumer behavior starts to shift. Airline surcharges go up. Logistics companies begin renegotiating contracts. $100 is the level that changes the conversation from oil is elevated to oil is a crisis. We crossed it today, and we need to see whether we hold it. The second level is $120. That was the intraday high during the worst of the Russia-Ukraine supply shock in 2022. If we close above $120 on a sustained basis, not just an intraday spike, but a multi-day close, it tells you the market believes this disruption is going to last weeks,
Not days. Curious. The futures curve right now is reflecting exactly this calculation. May 2026, Brent futures are at $110. June futures are at $102. July is at $95. The market is essentially pricing in some degree of resolution over the next several months, but it is not certain, and each day the strait remains effectively closed, that curve will shift higher. The third number, and this is the one that will dominate financial headlines if we get there, is $150. Qatar's energy minister mentioned it. JP Morgan's analysts have it in their scenario analysis. It is not the base case, but it is no longer a fringe scenario. At $150 per barrel, the global economic calculus changes dramatically. Recessions become a genuine risk in import-dependent economies. The Federal Reserve faces an impossible choice between fighting oil-driven inflation and supporting economic growth. That is a conversation no one wants to have, which is why the G7 finance ministers are meeting tomorrow to discuss a coordinated strategic reserve release. Watch that meeting carefully. Here is what the large institutional players, the pension funds, the hedge funds, the sovereign wealth funds, are doing right now, translated into plain English. Oil ETF inflows have exploded. The USO, the United States Oil Fund, which is the largest and most liquid way for retail investors to get exposure to crude oil prices, has seen volume surge to levels not seen in years. That is not retail investors driving that volume. That is institutional money repositioning rapidly. The CFTC positioning data, which tracks what large professional traders are doing in the futures market, showed money managers adding aggressively to net long positions in crude oil for multiple consecutive weeks heading into this crisis, which means many of the sophisticated players were already positioned for higher oil prices before the shooting started. Today's move validates those positions, and it is likely to attract additional institutional buying from managers who were underweight energy and are now scrambling to catch up. On the other side of the trade, the US government announced a $20 billion insurance program for oil tankers transiting the Persian Gulf. It is an extraordinary and unprecedented intervention, essentially the government backstopping the insurance market so that tanker operators can afford to move through the region. The fact that this program was announced and yet did very little to calm the crude market tells you something important about where institutional confidence currently sits. When a $20 billion government backstop does not stop the price surge, the market is telling you it does not believe the physical problem is going to resolve quickly. The Trump administration has also been in contact with Saudi Arabia and the UAE about increasing production to compensate for the losses from Iraq and Kuwait. Saudi Arabia has spare capacity. It could theoretically bring additional barrels to market within weeks. But here is the problem. Those additional Saudi barrels still have to get out through the same Strait of Hormuz that is currently compromised. More supply without a functioning export route does not solve the problem. The market understands this, which is why Saudi reassurances have had limited price impact. G7 finance ministers are convening to discuss a coordinated release of strategic petroleum reserves, the emergency stockpiles held by the US, Europe, Japan, and other major economies specifically for moments like this. The International Energy Agency would coordinate the release. If it happens, and if it is large enough, it could provide some temporary relief to prices. The U.S. Strategic Petroleum Reserve was significantly depleted during 2022. It has been partially refilled since then, but it is not at the levels that would allow for a prolonged large-scale release. This is a pressure valve, not a solution, and sophisticated investors know the difference.
Here is the one thing you need to watch tomorrow morning, and I want you to write this down if you can. The G7 finance ministers meeting. It begins early in the European morning, which means we may get headlines before US markets open. There are essentially two outcomes that matter. If the G7 announces a large, coordinated strategic reserve release, and I mean genuinely large, at least 1 million barrels per day for an extended period, you could see Brent pull back toward the $100 level as markets digest the additional supply. That would be a significant reversal from today's highs, and it would give you a clearer picture of where the true floor is in this market. If the G7 meeting produces vague language about monitoring the situation without a concrete release announcement, which is the more common outcome, expect oil to open Asian trading tomorrow with another leg higher. The $120 level becomes the next target in that scenario. We are also watching for any statements from Iranian leadership about conditions for reopening the strait. Any language suggesting even the possibility of negotiation would be a significant downside catalyst for oil. Right now, Iranian officials have been consistent and clear in their messaging. The strait stays closed as long as US and Israeli military operations continue. Watch for any shift in that language. It will move the market faster than almost any other single factor. Tomorrow on this channel, we turn our attention to gold, which, as you might expect, is doing something very interesting of its own in the middle of all this. Do not miss that episode. Brent crude at $114. The Strait of Hormuz effectively closed. 6 million barrels per day potentially at risk. The G7 meeting tomorrow. These are the coordinates of the moment we are in. You now understand not just the number, but why the number is where it is and what it would take to change it. That is the whole point of this channel. I'm James Harlow. This is The Right Chapter. Subscribe, and we will see you tomorrow evening with the gold story. And I promise you, it is just as important as what you heard tonight. Stay informed. Good night.